Okay, let's dive in. As of Friday, March 21st, 2025, the US dollar index. It's basically a way to measure how strong the dollar is against other big currencies, like the euro, the yen, the pound. It jumped up a lot recently.
Yeah, a noticeable move.
Yeah.
And it's not just some abstract thing. This directly affects how companies manage their money. That's what we're digging into today, how this surge in the dollar is impacting corporate portfolios.
Right. We're not talking about your personal finances here. This is about the big decisions happening in boardrooms,
Yeah.
like where companies choose to invest, how they protect themselves from currency risk, and even how they can use these market swings to their advantage.
Exactly. It's all about the corporate perspective,
Hmm.
how CFOs need to adapt their strategies in this environment.
So we're asking, what are the key moves CFOs need to be making in this surging dollar era? We'll look at the institutional traders, how are they navigating this? And then there's the whole debate around corporate share buybacks. Does a strong dollar change the game there? And for CFOs listening, what are the most important portfolio strategies when the dollar is on the rise like this?
To get us started, we've been looking at a ton of data market analyses to see what's happening right now, economic reports to understand the bigger picture, and then some really in-depth financial strategy pieces that show how companies are actually grappling with these challenges.
Our goal is to make it crystal clear how the dollar impacts those top-level corporate financial decisions. No jargon, just the knowledge you need to really get it. So let's start with the basics, the surging dollar. What are some of the first things we see in the market when the dollar gets stronger so quickly?
Well, even without specific numbers, a stronger dollar generally means that imported goods become cheaper for U.S. companies. Think of a manufacturer getting parts from overseas. Their costs could go down.
Right, so a win for some companies, but on the flip side,
On the other hand, U.S. companies selling their stuff internationally. They face a headwind. Their products become more expensive for buyers using weaker currencies. That could hurt their sales.
so that's an immediate impact on how competitive U.S. exporters are. And to see the bigger picture, we can look at what's happened before. For example, the European Central Bank in their economic bulletin from September 2023. They said that a stronger euro went hand in hand with tougher lending conditions and less confidence in the economy, basically, when it's harder and more expensive for businesses to borrow money. And there's not a lot of optimism about growth. Investors often seek out what they see as safer assets, which can make a currency stronger. Could be a similar situation with the US dollar now.
Yeah, you've hit a key point, and it's crucial to remember the US dollar's role as the main international reserve currency. It's the dominant currency in global trade and finance. So when its value changes dramatically, it creates a ripple effect for corporations doing business internationally.
Absolutely. So this leads us directly to capital allocation. How companies decide where to invest. How might a CFO at a multinational company decide between investing at home versus investing in other countries when the dollar is strong? On the surface, a strong dollar might seem like it makes international investments cheaper, but is it really that simple, or are there things CFOs need to watch out for?
Great question. At first glance, a strong dollar means your money goes further when you're buying assets or setting up operations in countries with weaker currencies. So CFOs might be more interested in buying foreign companies right now because their dollars can buy more of that company's shares. But the long-term view is more complex.
How so?
Well, future earnings made in those foreign currencies will be worth fewer dollars when they're brought back to the U.S. It's a balancing act. CFOs have to focus on the target company's debt,
Right.
especially any debt in U.S. dollars, because that debt suddenly becomes more expensive for the foreign company to pay back.
That's a great point about the debt. Yeah. So even if the initial purchase price looks good, the ongoing financial obligations could be a problem. What about those U.S. exporters? We touched on this earlier. They're facing some challenges. Can you expand on how a strong dollar could impact their profitability?
Of course. When the dollar gets stronger, U.S. goods become more expensive for international buyers. Let's say a European company is thinking about buying machinery from a U.S. manufacturer. If the euro weakens against the dollar, that machinery now costs more in euros. This can lead to less demand for U.S. exports, which can hurt the profits of U.S. companies relying on international sales. They might have to lower their prices to stay competitive, which eats into their profits.
And what about those big investment decisions, like buying new equipment or upgrading facilities? How does a strong dollar factor into those calculations for a CFO?
If a U.S. company wants to import equipment or materials from overseas, a strong dollar is good news. It makes those purchases cheaper. But they still need to look at the bigger economic picture. Is it the right time to make big investments regardless of the currency advantage? They also need to consider if relying more on imports makes their supply chain more vulnerable to future currency swings or even geopolitical events.
All this uncertainty around currencies highlights why risk hedging strategies are so important for companies doing business internationally. Why is it so critical for them to manage these currency risks?
Because if they don't manage them, those currency fluctuations can wipe out profits. Think back to that US company selling something in euros, and they're expecting payment in 90 days. If the euro weakens a lot during those 90 days, they'll receive far fewer dollars than they planned. Hedging is how companies protect themselves against these sudden and unpredictable changes in exchange rates.
And that's where the big players in finance come in, the institutional trading desks. They provide the tools and markets that companies need to manage these risks. We don't need to get into the specifics of things like options or forwards, but it's important to understand these are the tools companies use to lock in exchange rates for future transactions.
Right. Institutional trading is a complex system designed to help manage financial risks, including currency risk. These large financial institutions offer a variety of hedging products that allow companies to reduce their exposure to volatile exchange rates.
So given the dollar's recent surge, it's safe to say CFOs are revisiting their hedging programs. They might need to change how much they're hedging, which currencies they're hedging against, or even when they're hedging, to account for this new, stronger dollar environment.
Absolutely. They need to be proactive.
And some might even underhedge their foreign currency revenue if they think the dollar will keep getting stronger. They're essentially betting on getting more dollars later, but that's a risky move.
A high-risk, high-reward strategy for sure. Now let's shift gears and talk about the relationship between a strong dollar and corporate share buybacks. It's an interesting dynamic. How do these two things influence each other?
Well, a strong dollar can make U.S. stocks relatively more expensive for international investors because their own currencies are weaker. This might reduce demand for U.S. stocks from overseas. So, could a sustained strong dollar actually encourage more domestically focused buybacks? If expanding internationally becomes less appealing and returning money to shareholders becomes more straightforward.
Interesting point. If a company thinks its international growth is going to be slowed down because its products are less competitive due to the strong dollar, using cash for buybacks might become a more attractive way to increase shareholder value. The main reason for buybacks is usually to return capital to investors, or to signal that management believes the company's stock is undervalued. Currency definitely plays a role in how the market feels overall. But it might not be the direct reason for a buyback program, more like a factor in the overall capital allocation strategy.
Right, the CFO has to balance a lot of things. Cash flow, investment opportunities, debt levels, and the overall value of the company currency is another piece of that puzzle. Now let's focus specifically on portfolio strategies for CFOs in this strong dollar environment. Just from a corporate treasury perspective, how does a strong dollar affect how they manage their cash as short-term investments in different currencies?
A strong dollar creates challenges right away. If a company has a lot of cash in a foreign currency, let's say British pounds, and the dollar strengthens, the value of those pounds goes down when they're converted back to dollars. CFOs have to be very aware of this. They might need to rethink their currency holdings and look at strategies to minimize exposure to currencies that might weaken further against the dollar, maybe by converting those holdings back into dollars or other currencies that are more stable.
So it's not enough to just react to changes in currency values. Companies need a clear strategy that fits with their global operations and their risk tolerance.
Exactly. And if you think about the idea of business resilience from the BCG CEO Outlook 2023, companies that have built resilience, meaning they can adapt and bounce back from unexpected things happening, they're definitely better positioned to handle the uncertainties that come with big currency fluctuations. They've probably already got strong risk management processes in place.
It's also worth thinking about some ideas from behavioral economics.
Yeah.
The idea that our decisions are heavily influenced by the context we're in, as an introduction to behavioral economics discusses, this feels very relevant right now. A strong dollar creates a new financial context. Strategies that worked perfectly fine when the dollar was weaker might need to be completely rethought. Companies can't just keep doing things the same way. They need to consciously adapt to this changing environment.
Couldn't agree more. This highlights how important it is to constantly monitor what's happening and to be willing to adjust financial strategies as the economy changes. What worked yesterday might not work today.
And of course, nobody can perfectly predict what currencies will do in the future.
Yeah.
So what's the key takeaway for companies dealing with this uncertainty and these long-term currency trends?
The most important thing is to have solid and adaptable risk management systems in place. Companies need to be ready to adjust their hedging strategies, their capital allocation plans, and their overall portfolio management as currencies move. As the BCG CEO outlook suggests, managing these risks, including currency risk, is fundamental to creating long-term value for the company.
So to sum up, this deep dive into a surging U.S. dollar shows us some big implications for corporate portfolios. We've seen how it impacts those crucial decisions about where to invest, the absolute need for proactive risk management, and the potential connections to strategic financial tools like corporate share buybacks.
It's clear that a strong dollar isn't inherently good or bad for companies. It presents a complex mix of opportunities and challenges for those operating globally. While the lower cost of imports might be attractive, the potential for less competitive exports needs careful thought and strategic responses.
In the end, it comes down to careful planning and looking ahead. CFOs and their financial teams have to actively and constantly assess their exposure to currency risk and implement strategies tailored to their specific business models, their global footprint, and their tolerance for risk. In today's interconnected global economy, ignoring these powerful currency dynamics is simply not an option.
And this brings us to a final thought for you. As the global economy keeps changing, how might a sustained strong dollar reshape how companies invest internationally in the years to come? Beyond the immediate financial impacts, what bigger strategic changes might companies need to think about in a world where the US dollar remains strong? That's a question that will likely be at the top of the agenda in boardrooms worldwide.
That is something to think about. Thanks for joining us for the deep dive.
It's been a pleasure.